Hi, I'm Wes Moss with Money Matters. You found our channel, and over the last several weeks, we've gotten lots of questions in the comment section, and I love being able to answer these questions in comments, but today I wanted to do it right here with a video. I'm gonna go ahead and answer these questions right here on the channel. The first one is from D. Wello. I guess that's an email address. With all the market uncertainty right now, if you were within 10 years of retirement with a decent nest egg, high six figures, in your 401k, do you have any suggestions on how you would avoid taking a big hit that would be hard to recover from between now and the day you plan on telling the boss to shove it sideways? So that's good. That's a really good question. I love saying that to the boss, shove it sideways. I haven't heard that in a long time. The answer is we've got to make sure that as we're approaching retirement, let's call it 5 years away, 3 years away, or even if in the year coming up, so close, short range, 1 to 5 years. We need to make sure that we do have some sort of balance that avoids or helps us avoid taking a big hit. We never know when there's going to be some big political event or turmoil. Terrorism, wars, natural disasters, virus outbreaks. I mean, things happen here geopolitically, economically, around the world all the time, and it can have a major impact on the stock market. And it doesn't mean that the stock market doesn't come back. The problem here is with taking a big hit right when you're retiring is that you need the money now. And what you don't want to do, or what you want to avoid, is taking a big hit when you need the money, because it might take a long time for markets to recover. So it's actually, the problem here is something in investing called the sequence of your returns. Even if you have great returns over time, but if you have a 2 or 3 year period where you don't get a lot of returns and you need the money. So here's how I solve for that problem. Very simply, if you're doing a balanced allocation, and I've got a rule called the 15-50 stock rule. That means that if you think you're going to be investing or on this planet for 15 years or more, which certainly if you're 60 or 65 in retirement, that you should qualify for that rule, God willing, then you should have, at least if you're a moderate investor or above, moderately aggressive or aggressive, should, in my opinion on this, have at least 50% in stocks, 50%. But the other half is protected from markets. That's the key here. So you think about doing the math here for a minute. Let's say you have a portfolio where you have half in the stock market and half in some sort of safety bonds that are paying interest, treasuries, high quality corporates. Imagine in a terrible, terrible case scenario, the stock market goes down 50%, we have to be in a really rough environment for that to happen. But let's say worst case scenario, stock market does 50%. Well, the other half of your portfolio is supposed to stay flat in that period of time. And in many cases, safety assets actually rise when risk assets, i.e. stocks, are going down. So if you have a balance in your portfolio, counteracts, the safety side counteracts and actually goes up often. So if you just do the math on a portfolio, half goes down 50% and the other half stays flat, then the worst case scenario mathematically is down 25%. Still a big hit. But 25% is recoverable much easier than negative 50. Now, imagine that the other side actually goes up by 5% or even 10%, and then your losses are much more mitigated to so let's call it to the teens or the low 20s as a worst case scenario. And that's just math. So I believe in utilizing this balance for every investor. And I think one other layer that's really important is thinking about an income stream. And if you have an income stream that's 2 or 3 or 4% a year through dividends or from stocks or high quality stocks, interest from bonds, and then distributions from things like pipeline companies and publicly traded real estate, the income stream, even during a big market downtrend, doesn't necessarily get hit at all. If you have high quality companies, they really like to keep their dividends steady. And if you have high quality bonds, that interest should stay steady. So if you think of it this way, and this is part of the philosophy I use from an investment standpoint, also to avoid taking a, quote, big hit, you're able to rely on that steady stream of income while the portfolio goes through those oscillations, because the income stream, even though the value of your portfolio can go up and down, or in this case, down in a worst case scenario, the income actually should be staying very, very steady. And if you're used to that and you're living off the income, it gives you less worry about the value of the portfolio. And it gives you some time, both in practicality and really kind of just emotionally and mentally, to allow for you to be patient for your portfolio value to come back. So I think there's a lot to that, but I think the key here is balance, both risk and conservative assets, and then thinking about the steadiness of a potential income stream to help you get through those big market oscillations. Thank you, D. Wello, for the question. I hope that was helpful. This question is from Corinne, and this exercise here on YouTube reminds me of our radio show on Sunday mornings, 9 to 11 on WSB Radio. And if you're not in Atlanta, you can listen to 95.5 WSB if you have a smart speaker. So if you have Alexa, you can just say, hey, Alexa, play 95.5 WSB and listen to our radio station anywhere on the planet if we have an internet connection. So let's go to the next question. Corinne, can you please go over which financial ratios you use the most and how you analyze them to help you determine the best stocks to buy and hold for the long term? Here are a couple different ratios. Let's start with something I call the FTG, or filling the gap. Filling the gap is a really important exercise, and it can take what can be really complicated. You can do a 25 or 30 page financial plan, but really what any financial plan is getting to, the crux is solving for the gap you have between your guaranteed income, let's call that Social Security that most retirees are going to get, pension, monthly pension payment, which some retirees are going to get, and then all these other income streams that you might have, like rental income or even part-time work. But certainly nearly every retiree is going to have Social Security. So let's just make this a really simple calculation. If Social Security is $3,000 a month and you need $5,000 a month, then the gap between the guaranteed income stream and your need is $2,000 a month. So what you need to do then is solve for that $2,000 a month. Then you can look at your portfolio and any sort of retirement assets that you have. Let's say you have $500,000 or $1 million. You've got to then figure out, how do I solve for $2,000 or $24,000 a year? If you have $1 million, that means you need to have an income stream of 2.4% that would pay you your $24,000 a year, or $2,000 a month. If you have $500,000 a year, it'd be double that. You'd need about 4.8% per year in income stream or withdrawals from your portfolio, and that to solve for that gap. So to me, the FTG, or filling the gap ratio, is the very crux of the heart of all financial planning. It's a really simple ratio to figure out, and then it helps you on the investing side to figure out how much income you want to generate from your portfolio. Now, how do you determine stocks to buy or just hold for the long run? Well, the reality here is that we look for dividend growing companies. So we do the variety of screens on the overall stock market. Let's call it 15 different metrics that solve for or funnel down to companies that have high quality balance sheets, they're able to grow their earnings. One of the screens we use will look for earnings, or a measure of EBITDA relative to a company's enterprise value, which is their market cap, including their net debt, essentially. And if you've got strong ratios, that means that you've got a company that has plenty of earnings to cover any sort of debt ratios, giving it kind of a high quality standard. And if you solve for companies with the best ratio in that category, you're finding companies that are not leveraged financially, and that's a big part of how we look at screens. The next part of this is we want to look for dividend growth. So we don't want to see a company that's just keeping their dividend flat for a lot of years. If you look historically, since the early 1970s, companies that are raising their dividends, even if it's 1% a year, if they're raising their dividends, or if it's a company that's initiating, paying a dividend for the first time, if you're able to isolate those companies historically, that has outpaced the market or the general S&P 500 pretty significantly. So we try to look for high quality companies that are not leveraged and companies that are growing their dividend at the same time. And as long as those companies continue to stay in a place where they're not leveraged heavily, their earnings easily cover any sort of debt service, and they're raising the dividend, then that's a company that we are typically very comfortable holding on to for the very long term. And of course, I've got to say, well, there's no guarantees in any of this, but you've got to be vigilant in making sure that these companies are continuing to maintain these effectively high quality standards. Let's go to a question from Barry. Barry asks, what should your money be invested in? What types of investments and percentages during retirement from day one? And how would that change over time as one ages until, say, 95, if 95 is the end game? All right, listen, I hope, Barry, 95 is you get past 95. But the point here, and Barry brings a really interesting or important point, is if you retire at 60, now that's an early retiree, so let's say 65, and then you live till you're 95, that's 30 years the money has to last, right? That's a long, long period of time. And I think we very often think of retirement, I've got to now get my money to be really conservative because I'm now in retirement, my time horizon now is 0. That's not true. I think your time horizon in retirement is still as long as you're going to live. It could be 20, God willing, 25, hopefully 30, 35 years. So your time horizon in retirement isn't 0. It's 20, 30, maybe even 40 years. And I think we have to plan for that. So again, I would go back to my 15-50 stock rule, which really says that if you've got 15 years on this planet, you think to invest or more, I typically want you to be considering at least 50% in the stock side of the market, or dividend, or particularly dividend paying stocks. Now we'll talk about that in just a second. One of my, Warren Buffett's teacher, Benjamin Graham, in his book, The Intelligent Investor, actually talks about a ratio that's similar to this and says that for a lot of investors, a ratio of half stock, 50% in stock, so risk assets that can go up and down, but up over time, and safety assets, think bonds that are that are a lot steadier, maybe call it 1 or 2 or 3 or 4% per year with not a lot of price volatility. That in Benjamin Graham talks about, that's a good balance for an investor who's 30 or 90. And that really hit me in learning about that ratio, because whether you're 30 or you're 90, there's a lot of comfort and balance. Now, there are plenty of investors that say, look, I want to be 100% stocks all the time. You got to have an iron stomach for that. And that can be very emotional, particularly when your assets get to be big, $1 million, $2 million, $5 million. Or if you get the entire amount fully at the mercy of the market, ups and downs, that can really start to get nerve-wracking. So whether you're 30 and you have 100,000 or you're 60 and you have 5 million, thinking about a ratio where you have half in equities or stocks can be very helpful if the other half is in something that is ultimately steadier and safer. Now, the next piece of the equation, and this goes back to my philosophy about income investing. What does income investing mean? Well, income investing is very simply a philosophy that we use at our firm in the real world, when we're not doing YouTube videos here, Capital Investment Advisors, that helps you simplify a very complex world of investing. And think of it this way: if I have a portfolio and I have 3 pieces to the portfolio, so rather than one product, I have a variety of instruments in 3 categories: stocks, or high quality companies that pay dividends; bonds, and a variety of bonds, so I have diversification there too within bonds that pay interest. And then a third category I call alternative investments that pay out distributions. Think pipeline companies that pay out 4, 5, 6, 7%, depending on the company. And real estate investment trusts, or publicly traded real estate, that typically will pay 3 or 4 or 5%. Add all those 3 together. We've got the cash flow from stocks, the cash flow from bonds, and the cash flow from these alternative areas. Now you've got an income stream. You've got a steady paycheck. And if you've got 20, 30, 40 different components all creating these smaller income streams in your portfolio, it ends up to be what could be a pretty substantial stream or river of income that should not change a whole lot in any given year, even though the market price valuation can go up and down. That's the way I look at putting this together. I would encourage retirees to rethink their time horizon. Just because you're retired doesn't mean your time horizon is 0. It is hopefully a very long period of time. Secondly, I go back to our philosophy about income investing that can help you have some steadiness in an otherwise very unsteady stock market for retirees. This is a lot of fun answering these questions from the comment section in videos that we do right here on the YouTube channel, Wes Money Matters. So keep submitting your questions either here at the YouTube channel or through wesmoss.com, and we'll get to them right here like we're doing today. This question is from Mark. Mark says, Wes, what are the options when too much of your net worth is tied up in your house? This is a good question. But you don't really want to sell or move. Man. Selling would free up the cash to retire sooner, but would also trigger capital gains. how to make all that how do I make all that capital in the house work for me? Question mark. Woo. Wow, that's a good question. It's a pretty hard question to answer, actually. And well, a couple of thoughts here. First of all, remember that if you're married, husband and wife together have $250,000 in long-term capital gain exemption in your primary house. So just remember that as long as you've lived there 2 out of the last 5 years, it's a really big exemption. So if you bought a house for $400,000, husband and wife, and now you sell it for $900,000, the whole $500,000, you get an exemption for that $500,000. So just remember that there is a big exemption for capital gains in your primary home. So Mark, for a lot of retirees, the obvious choice, and you've addressed this in your question, is to move and downsize and be able to unlock some of the equity in your house. Let's say your house is $800,000 and you can now move to something $400,000 and still love where you are. Maybe it's a smaller footprint, easier to maintain. Then you've got that $400,000 in equity unlocked to now put in a retirement account and generate income. Now, the problem, the quandary that you're in is you don't want to move. And a lot of families don't want to move. A lot of families, the whole downsizing initiative is difficult because housing inventory is tight. It's hard to find a place that's a lot less money, significantly less that you want to live in. So this is a pretty common question and quandary for retirees. And here's one solution that I've seen several families that I work with utilize. And that is, particularly if you have a big house that's got a lot of equity, it means it's probably a nice house. Maybe you've got 3 different floors. And in cases where I've seen families that have 3 different floors, particularly if you live near a major metropolitan area. So let's say you're in Philadelphia or Atlanta, or you're near Austin, or you're in Denver. As long as you're near a metro area, you've probably got a ton of demand for Airbnb rentals. So if you've got this big house and it's just you and your wife, then what are you doing with all the space? Well, why not take the whole basement area, make sure it's finished, and turn it into an Airbnb? Or take the whole 3rd floor and turn it into an Airbnb and generate income from one floor. Think of it as like a piece of your portfolio that should at least be paying you some income. And you could generate $500 a month, couple $1,000s a month, depending on your housing situation and how close your home is to a metropolitan area where there's tons of events throughout the year and people want to rent and they'd rather stay in a house rather than a hotel. Now, you may cringe at the thought of you have guests coming in and out, but if you have a separate entrance, it can be a lot like a bed and breakfast, hence the name Airbnb. And I've seen it work for tons of families and not actually be nearly as intrusive as you might think, and generate a ton of extra income throughout the month. Mark, hopefully that is helpful. It's a tough question to answer, but that's something I've seen done in real life many, many times. Everyone, thanks for subscribing here at Westmoss Money Matters and liking these videos and commenting on these videos and sharing with your friends. It means a lot to us, and we will continue to try to answer your questions and be as helpful as humanly possible. Remember, when we're not doing YouTube videos, I'm a real life financial advisor, the chief investment strategist at Capital Investment Advisors, and I sit down with families just like you, preparing for retirement or in retirement, right here at the same desk, day in and day out. And it's something that we love to do. We love to help. You can find us at westmoss.com, or you can click the link right below this video to get in touch with us. We'd be happy to help. Hope you have a profitable rest of your day.